After a volatile stretch in the civil construction market, we've been tracking how the industry sentiment is shifting, and the data is starting to tell a more structured story. What we're seeing isn't a simple cycle of optimism or decline. It's a market continuously rebalancing in response to shifting project pipelines, tighter margins, and increasingly selective bidder behavior. As conditions evolve, so is leadership thinking about the next 12 to 18 months. Hi, I'm Taylor Maurer, founder and senior managing partner at Heavy Civil Resource Consultants, a boutique talent search firm focused on the heavy civil construction industry. Looking first at early 2025 versus Q1 2026, sentiment has clearly redistributed. Strong growth edged up slightly from 24% to 25%, showing stability at the top end. Moderate growth declined from 43% to 33%, reflecting a meaningful compression in mid-level confidence. Status quo stagnation rose from 22% to 33%, signaling more firms shifting into a holding pattern. And shifting decreased from 11% to 9%, remaining present but not accelerating. Now, comparing Q4 2025 to Q1 2026, we actually see a pullback in confidence rather than a rebound. Strong growth decreased from 33% to 25%, and moderate growth fell from 44% to 33%, indicating a contraction in growth sentiment. At the same time, status quo stagnation increased from 18% to 33%, and shrinking rose from 0% to 9%, signaling a reemergence of contraction in the market. When you zoom out across the full timeline, the pattern is less about straight trend and more about volatility and rotation between segments of the market. Late 2025 reflects a peak in confidence, followed by a more fragmented and cautious reset into early 2026. Take a look at this chart. It visually reinforces this shift. The yellow moderate growth line shows a rise into late 2025, followed by a decline into Q1 2026. The red status quo stagnation line drops before climbing sharply in early 2026, and strong growth line peaks in 2025 before easing, and the shrinking segment disappears briefly before coming back in early 2025. This full view highlights not just movement within growth categories, but also how the contraction temporarily fades before returning, reinforcing the market's uneven and evolving nature. The market is not moving uniformly. It's splitting into two different realities depending on backlog strength, geography, and sector exposure. Layered on top of this, geopolitical tensions between Iran and the US have added additional pressure to global energy markets, pushing oil prices higher and increasing cost volatility across transportation, materials, and supply chains. These dynamics are acting as a stress test on infrastructure-linked sectors and broader industrial activity. In this environment, the advantage increasingly shifts towards firms that are disciplined in bidding, intentional in hiring, and capable of scaling execution without losing control of cost or schedule. If you've got additional insights, feel free to share them in the comments. This is a conversation worth continuing as the market evolves. Thanks for watching, and we'll see you soon.